let's just pull out what a monthly payment is. You'll hear the term PITI. Okay? PITI stands for principal, interest, taxes, and insurance. Now, principal is typically, there are loans that are called interest-only loans where you're not paying any principal at all, you're just going to pay the interest. But most mortgage loans are what are called amortized, where you take the loan amount and you break it down over 30 years, or you break it down over 25 years, and every month you're going to have a monthly payment that has a balance of principal and interest. And I'll be honest with you, for the first 20 years of your mortgage loan, it's almost all interest, okay? You're not really paying down the principal. But it is called PI, so principal and interest, and you can look at it every month and see like, oh, it's 80, 98% interest, and then it's 2% principal or what have you. Then you have taxes. And even if you own the house outright, regardless of how much you owe on the house or how much you borrow to buy the house, you're going to have to pay real estate taxes. Real estate taxes are what you pay to your jurisdiction, right? Your Fairfax County, and they take those monies, and a lot of that money goes to pay for schools. That's a big chunk of where schools get their money. So those go to taxes, and taxes are based on how much the house is going to appraise for, or really what it's called is assessed for. So the county comes in there and says, this is a $200,000 house, $400,000 house, $800,000 house, and then they have a tax rate and they multiply it and they say, you owe $10,000 in taxes. So those taxes are going to be broken down every month if you do something called escrowing. And escrowing just means rather than the lender's like, listen, we could let this person pay the taxes, but if they don't pay the taxes, we could let the homeowner pay the taxes, but if they don't pay the taxes, then the government's going to seize the home, and the home is our asset that is the collateral for our loan. So what if we just took that money out? It's kind of like your employer withholding taxes and keeping taxes, and they keep the taxes and send it directly to the government. So what will happen is the lender will take that money and put it into escrow. They'll put it into a fund, and it's only used for paying the taxes at the end of the year. And if the taxes go up at the end of the year, you might have to pay a little bit more. If the taxes go down, or if they collected too much, you might get a little bit of a refund. The last chunk of this is insurance. And I'm going to talk about the most common type of insurance, which is homeowners insurance. You got to remember this whole process, right? The bank, the mortgage lender, is lending you money to buy the house. The most important security for that loan, I mean, they're evaluating whether whether you're going to pay it back, but they're always keeping in the back of their mind, hey, what happens if this person doesn't pay us? What are we going to do? We need to be able to foreclose on that house, take that house over and sell it. Because remember, you own the house. They don't own the house. But they have the right to go in and sell it if you don't pay them. So homeowners insurance, you'd probably want to get homeowners insurance anyway, right? Homeowners insurance is, a tree fell on my house. I need to repair my roof. My house burned down. I need to do something about that. But it's all about the property. So they want homeowners insurance too, because if you don't buy homeowners insurance and the house burns down, well, that stinks for you because you don't have a house anymore. But it really stinks for them too because they now don't have that asset anymore. So they're going to insist on homeowners insurance. And in some cases they escrow for that, but you can set up your own homeowners insurance and pay it the same way you might pay your car insurance. But there's another type of insurance, and we'll talk about it later. I'll just introduce it now. Sometimes if your loan is, let me just say it, and we'll talk about it later. There's something called private mortgage insurance, and they call it PMI. And PMI is something that you get when the loan amount that you're borrowing is higher than the lender is comfortable with based on the value of the property, but they still believe that you're a good risk. They just want a little extra insurance. And so this is basically insurance not for when the house burns down. This is insurance if you don't pay the loan. And so we'll talk about that later when we talk about loan-to-value ratios. All right. So the first order of business, though, is PITI. Of course, the reason I started talking about all this in the first place was debt to income ratio. So let's revisit it.